How big oil companies made record profits in 2022 by benefiting from the surge in oil and gas prices that followed Russia's invasion of Ukraine. The year 2022 was a blockbuster year for big oil. The five largest oil companies in the world, ExxonMobil, Chevron, Shell, BP, and TotalEnergies, more than doubled their profits to a staggering $219 billion, breaking all previous records in the history of the industry. But how did they achieve such extraordinary results in a year that was marked by geopolitical turmoil, climate change concerns, and energy transition challenges? The answer lies in the surge in oil and gas prices that followed Russia's invasion of Ukraine in November. Russia's military aggression against its neighbor triggered a global energy crisis, as Europe faced the threat of losing its main source of natural gas imports. Russia supplies about 40% of Europe's gas needs through pipelines that cross Ukraine. As tensions escalated, Russia reduced its gas exports to Europe, creating a supply shortage and driving up prices to record levels. The high gas prices also boosted the demand for oil, as some power plants switched to using oil instead of gas to generate electricity. Oil prices soared to over $100 per barrel for the first time since 2014, benefiting oil producers around the world. Big oil companies were among the biggest winners of this price spike, as they cashed in on their existing oil and gas reserves and production. They also benefited from their diversified portfolios, which include refining, trading, and chemicals businesses that thrived on the high margins and volatility of the energy markets. Some big oil companies also used the opportunity to advance their climate ambitions by investing more in renewable energy sources and low-carbon technologies. For example, Shell announced a $10 billion investment plan to develop green hydrogen projects in Europe, while TotalEnergies pledged to increase its spending on renewables by 50% to $12 billion per year. However, not everyone was happy with big oil's windfall profits. In Europe, several governments imposed windfall taxes on oil companies, aiming to redistribute some of their earnings to households and businesses that were struggling with high energy bills. ExxonMobil sued the European Commission over this measure, arguing that it was unfair and counterproductive. In the US, President Biden criticized big oil for sending money to shareholders instead of producing more oil and gas to ease the supply crunch. He also urged them to do more to address climate change and support his clean energy agenda. Big oil's record profits in 2022 were largely driven by external factors that were beyond their control. The question is whether they can sustain their performance in 2023 and beyond, as oil and gas prices have already started to decline due to easing tensions between Russia and Ukraine and increasing supply from OPEC and other producers. Big oil companies will also face growing pressure from regulators, investors, and consumers to accelerate their transition to a low-carbon future, while maintaining their profitability and competitiveness in a changing energy landscape. One of the most controversial aspects of big oil's business strategy is how they spend most of their profits on stock buybacks and reinvesting in shareholders, rather than increasing their investments in renewable energy sources. Stock buybacks are a way for companies to increase the value of their shares by reducing the number of shares outstanding. This benefits shareholders, who see their share prices rise, and executives, who often receive bonuses based on share performance. But it also means that less money is available for other purposes, such as expanding production, improving technologies, hiring workers, or developing clean energy alternatives. Big Oil has been ramping up its buyback programs in recent years, especially as oil prices have surged to near $100 a barrel. The five oil giants, BP, Chevron, ExxonMobil, Shell, and TotalEnergies, spent more than $20 billion on buybacks in the first half of 2022, and are likely to spend even more in the second half. ExxonMobil alone plans to spend $30 billion on buybacks in 2022, and by contrast, these companies spent only about $8 billion on renewable energy projects in 2021, which is less than 4% of their combined profits. This imbalance between fossil fuels and renewables has drawn criticism from environmentalists, politicians, and some investors, who argue that big oil is not doing enough to address the climate crisis and transition to a low-carbon economy. They point out that oil and gas production contributes to greenhouse gas emissions, which cause global warming and its devastating impacts. They also warn that big oil is risking its long-term viability by relying on a finite and polluting resource, while ignoring the growing demand and potential of clean energy sources. Some governments have taken action to pressure big oil to change its behavior. President Biden has accused oil companies of profiteering off surging energy prices and called for an end to their tax breaks. Britain has announced a special tax on the extraordinary profits of oil and gas companies. Some Democrats have demanded that big oil divert more resources into increased U.S. production and renewable energy instead of buying back their own stock. However, big oil has defended its buyback strategy as a way to reward its loyal shareholders and win back new investors, who have been fleeing the sector for more attractive and sustainable opportunities. Big oil argues that it is still investing in renewable energy projects, but at a pace that is consistent with market demand and profitability. Big oil also claims that it is working hard to reduce its carbon footprint and support the energy transition, by improving its efficiency, capturing and storing carbon emissions, and developing low-carbon fuels. The debate over how big oil should spend its profits is likely to continue as long as oil prices remain high and the climate crisis worsens. The question is whether big oil will use its windfall to accelerate or delay the shift to a greener future. Big oil companies are facing scrutiny and criticism from governments, activists, and consumers for their role in contributing to the climate crisis and failing to align with the goals of the Paris Agreement. The Paris Agreement is a landmark deal adopted in 2015 by 195 countries to limit global warming to well below 2 degrees Celsius, preferably 1.5 degrees Celsius, above pre-industrial levels. To achieve this, the world needs to cut its carbon emissions by 80% but big oil companies have been investing billions of dollars in expanding their fossil fuel production and infrastructure, while making vague and insufficient pledges to reduce their emissions and support clean energy. For example, ExxonMobil, one of the largest oil companies in the world, has predicted that oil demand will only increase over the next decades, and that oil, coal and natural gas will power 80% of the world's energy needs. This is incompatible with the Paris Agreement and the science of climate change. ExxonMobil has also been accused of misleading the public and shareholders about the risks of climate change for decades, and of funding groups that deny or downplay the reality of global warming. In a historic defeat for ExxonMobil, a small activist hedge fund called Engine No. 1 managed to unseat at least 2 board members at the company's annual meeting in May. The hedge fund argued that ExxonMobil was failing to adapt to a low-carbon future and that its business model was putting its long-term profitability and survival at risk. The hedge fund also had the support of some of the largest institutional investors in the world, such as BlackRock and Vanguard, who have been increasingly vocal about holding companies accountable for their environmental impact. Another major oil company that faced a legal setback in May 2021 was Royal Dutch Shell. A Dutch court ruled that Shell must cut its carbon emissions by 45% by 2030 compared to 2019 levels, in line with the Paris Agreement. This was a landmark case brought by environmental groups and thousands of citizens who argued that Shell was violating their human rights by endangering their lives and livelihoods with its reckless emissions. Shell said it was disappointed by the verdict and that it would appeal, but it also acknowledged that it needed to accelerate its transition to low-carbon energy. Chevron, another oil giant, also faced a shareholder revolt in May 2021, when investors voted in favor of a proposal that would require the company to reduce its emissions from the products it sells, not just from its own operations. This means that Chevron would have to take responsibility for the emissions generated by its customers when they burn its oil and gas. Chevron had opposed this proposal, saying that it was already taking steps to address climate change and that it had no control over how its products were used. These events show that big oil companies are under increasing pressure from various stakeholders to take more ambitious and concrete actions to tackle the climate crisis and align with the Paris Agreement. They also show that investors, courts and consumers are no longer satisfied with empty promises or greenwashing from these companies. They demand real change and accountability from big oil, or else they will face legal challenges, financial losses and reputational damage.